Oh, and we're live. All
We
right,
are.
guys. Welcome to the first ever live edition to Market Thoughts with the first ever guest on Market Thoughts, Mr. Nolan Parker, member of the Leaders Investment Club, named one of the 20 under 20 for finance from Business Insider, and named one of the most important people in finance for the age of 20. Is that correct?
That is.
All right, and we tried this. We tried this once before, but we couldn't get it to work right. But now now we figured it out. We
We
figured
did.
it out.
Test runs are over.
Yeah, test runs are over. So I think we should probably just dive right into it. So markets have been pretty interesting so far in 2015.
Definitely.
Wouldn't you say? Um,
Go ahead.
I just want to go out there and just say, what are your I don't like price targets at all, but what are just your thoughts for the overall markets? I just say, do you see S&P going up or down? Oil up, down, bonds up, down type thing.
Yeah. I think I see the market going up. I see the market going up in 2015, not necessarily straight up. When we had our conversation on Sunday, it was, I said there was no signs that I really saw of any kind of market top or any kind of weakness really in the market, broadly speaking. But the sad truth and unfortunate truth is that over the last 3 days, that has kind of, although today there was some repair that was done today, but there's no doubt that since the first of the year, the sellers have been in control. And that being said, I think that for 2015, I see the market going higher. I think rates probably stay lower for longer unless there's something that the Fed does to alter that. I see them hiking rates probably in the back half of 2015. But yeah, I mean, generally speaking, I see the market going higher. That being said, I mean, I definitely think that you could see a pullback because I think people are so conditioned to buy the dip and buy the dip. When that doesn't work, and I'm not saying that it's not going to work this time around, but when that doesn't work, it's going to be a fast and hard fall. Now that being said, even if you fell 20%, right? I mean, you're talking about the market losing a fifth of its value. If we close down 20%, like let's say today we closed down 20%, I would go 100% invested. You know what I mean? Because historically, every 3 years you get a 20% decline. And there's been multiple 20% declines in secular bull markets. So people love to freak out. The reality of it is that over time, the general status of things is pretty decent, and it's probably going to go higher.
Yeah, I mean, I definitely agree with you that I think we're going to go higher. I mean, we talked about, the economic numbers definitely surprising to the upside. I mean, December, the ISM manufacturing numbers weren't that good, but we just got private payroll numbers that were pretty good. And, we printed 5% GDP. The Fed's coming out saying they think, the lower oil prices will help to GDP. They see, this kind of disinflation type thing happening because of oil, and that they're going to raise rates regardless.
Right. Obviously the minutes are backward looking, right? Because that was the December meeting minutes. But yeah, I mean, I think that there was definitely a shift in their attention. Now it's kind of away from the labor market, which we kind of knew that already, right? Because I mean, Bernanke used to talk about 6.5% being the target, right? And that came and passed, and nothing happened. So I mean, the whole labor market has kind of been thrown out the window for a while. But like we were talking about, on Sunday, you had today 241,000. The previous was 227. The forecast was for 227. So you're seeing growth. In the labor market, you're seeing the improvement. The participation rate is not dropping as fast as it was. So those signs are encouraging. You still aren't seeing robust wage growth, which you'd like to see. Because I love to point out the fact that housing has risen over 300% in the last 20 years, 30 years, and wages have risen 3%, right? So we've been able to afford these excessive housing prices through debt and or credit, excuse me, not debt, but well, debt is credit, but credit, right? And we had a credit crisis, in 2008. But generally speaking, things are improving, so that's encouraging.
Yeah, I definitely think the economic data is in the U.S.'s house. I was a little bit concerned. I really was coming into today, and then when I saw, the private payroll numbers, I was actually pleasantly surprised. I think that's what the market really has rallied on today. I mean, obviously we're going to have a lot of data coming up, and we won't be able to discuss that on here, but we had a lot of just good stuff that happened today. I mean, the trade balance is below 40,000. The first time 40 billion. I'm sorry, for the first time since I have been paying attention to it, and that's because of the oil drop. But there's the bond market still worries me quite a bit. It's been the global rates move has been crazy. I don't think there's any other way to describe it.
Yeah, I mean, when you have Japan, entering, near almost 25 basis points for their 10-year, you have Germany under 50 basis points. You have us, closing in on below, or below, I'd say, or I wouldn't say below, but closing in on 1.5% on our 10-year. Yeah, there's definitely fear out there in the market. If it's not seen in the equity market, it's definitely seen in the bond market, because they're sucking up bonds like it's water out there. So
Yeah, I was actually talking to Jeremy Wilkins Smith before we actually went on air, and we were talking about because he trades FX and currencies, and
right.
has been since around '08. And I was talking to him, and I'm like, I for one wasn't paying attention to interest rates back when I first started out, because I started off in the spring of '08 in the midst of the crisis. But we were talking about the move in boons, 10-year boons, and I was like, okay, they start off the year at 2%, and now they're down to 0.5%. Is this what QE looked like back in '08? Are we experiencing QE firsthand, and we're just not used to it because we weren't around back then?
So what's your question? Excuse me, say it one more time.
I'm saying, do you think that the rate and that the move in FX around the world, especially boons, is a QE-like move?
No, because QE was, well, yes and no. Because yes, in the sense that QE's job and purpose was to support the bond market, obviously drive yields lower, make it credit easier. So yes, in that sense, but no, in the sense that I don't think people are buying, buying treasuries or boons to help the economy. They're doing it because they're hiding, right? Because they're fearful of. They're like, I'm not going to put my money in the equity market. Germany had a negative year. Most of Europe had a negative year. I mean, think about that, right? So we had a positive 12% year, which 90% of fund managers couldn't even beat, okay, which is pathetic and sad. And then you had Europe, which, going into 2013, everyone said, oh, there's a relative value. Well, apparently there wasn't much value there because they had a negative year, right? So I think that this global FX move has to do with the fact that Europe's overall economy is not as stable as people thought it was. Going into 2013 and 14, I think that people are hiding out in bonds because it's the safest place to be, and they know that central bankers are not going to let the bond market explode. The equity market, they may, who knows, but I think that people know that central bankers can directly affect the bond market, and that's where they're hiding out right now, and they're getting capital appreciation and they're getting the yield from it. So I think it's a perfect storm, really. And what that means in terms of the global economy, I know for us, I mean, it would tell you, because the 10-year is supposed to forecast two things: inflation and growth rate, and it's supposed to be a combination of those two things. And if you're having a 1 point, there's a big disconnect between having a less than 2% 10-year and a 5% GDP print. It just makes no sense with no inflation, right? And we've talked many times, and one of the reasons we have no inflation is because of the interest on excess reserves. Over 75% of the money supply is at Federal Reserve banks, being held at Federal Reserve banks, which doesn't allow most of the money to be in the float, so you're not seeing that inflation. When they take that away and banks start loaning money again, then you'll see inflation pick up, so then that may cause rates to rise a little bit, and then you may see it reconnect with the growth rate, and you may see things pick up and accelerate. But there's definitely a disconnect between inflation expectations, growth rate, and general fear in the market.
Do you think it's that the bond market to an extent has become more bullish, and I mean bullish in the term of people wanting to buy bonds because they know the whole central bank will go and will do whatever it takes to keep the bond market afloat? Do you think that's distorting the prices a little bit? Because like you said, a 5% GDP print should not mean sub 2% on a 10-year. There has to be, just like just like in the stock market, there must be some type of market distortion. If you have if you have a short S&P ETF, it doesn't always mirror the S&P's performance negatively exactly. There's always a little bit of distortion because it is a market tool.
Right. I think you're exactly on. It makes no sense. If you were to tell someone 2 years ago you're going to have equities 4% off their highs, you're going to have the bond market at below 2%, and you're going to have the last GDP print was going to be 5%, and inflation's going to be lower or the same that it has been for the last 3 years, people would go, impossible, right? I mean, it doesn't make sense. So obviously, Brian Kelly actually says this a lot, which either the bond market's wrong or the stock market's wrong. So what that means, he never really breaks that down, but what that means is that either rates are capitulating and this is their last push higher in price or lower in yield before they roll over, and all hell breaks loose, in which case that may be good for the stock market, right? People are selling bonds and going to equities, or there is some type of people love to say deflation. I don't think it's deflation, but there is some type of global harbinger out there that people are afraid of that the equity market has not picked up on yet. And I will tell you, if you look at not the S&P 500, but if you look at the QQQ, which tracks the NASDAQ 100, it may be telling you something, because it did not set a higher high in December. Okay, it had the 10% sell-off in October. It rallied to a new high. It sold off about 5% with the rest of the market in, what was that, early December, right? And we rallied back, but it did not get back to new highs. Well, check out the NASDAQ 100, which is the 100 largest market cap of the NASDAQ, 100 market cap, the largest 100 market cap stocks in the NASDAQ. It's outperformed all the other indexes by a not even close margin. And so for them to not set a new high when the S&P did, it's a little concerning.
Yeah, I definitely see what you mean there. It looked like it peaked out right off of November, not December, on what looks like to be pretty tiny volume.
Right, exactly. Very thin volume up there, and that if we set a lower low, then that tells you right there that there's something else going on. Not necessarily we're gonna have some global epic collapse, but probably that prices need to go a little bit lower before we get some real buyers come back in. Because look at the volume that you had today, super light. Well, not super light, but generally lighter than it's been the last couple of days. If today was the end of this 5% correction we've had, they should have ripped it, right? And they just really didn't. 1% and a basis point or a quarter basis point, that's kind of whatever, really, So,
yeah,
but I'm really.
We were talking about this on Sunday when we did our pre-talk, I guess you could say, is
Right.
when you look at the August kind of sell-off and you look at all these other sell-offs, you had overwhelmingly selling volume,
Right.
but on October and this last December, you had volume pick up on the up days when normally it hasn't after a sell-off, like in
Right.
August.
Yep. And so that's why that's why I said, in the beginning of our chat today, I said that today was they partially, today was a partial win for the Bulls. I'd really call today a neutral day because the Bulls didn't really win, the Bears didn't really win. Because the Bulls, if today was going to be the way it's been, like you said, off of the October lows, off of the December lows, they should have had ripping volume, and they just didn't. So that is a little bit cause for concern. The fact that we're so close to setting a lower high and a lower low, that's cause for concern. So I think maybe a test of the 200-day moving average isn't out of the question. I think that's probably pretty normal. But we'll have to see what happens.
Yeah, I completely agree with you there. I mean, it is a little concerning that because what we both talked about, that with the volume that it felt better was that was that because on the up days the volume was so huge. Now, I'm looking at the S&P chart and I am thinking to myself because a lot of names in the S&P it did kind of go off of a rally yesterday. So maybe, looking at a chart where it says all red volume, maybe that isn't entirely accurate because it did rally a bit into the close of yesterday. So maybe, you give a little bit of the volume over to the Bulls and maybe it's even or something like that. But it's definitely not like we saw on October or December.
Right. And well, one comment about yesterday, they did rally him back, but in the last 20 minutes, the Bears smacked them down. So they kind of won, but at the same time, they kind of didn't. And so I think we were just extremely oversold. And today was just an oversold bounce. One thing that I like to look at is the 5-day moving average, and because that really is your shortest term kind of indicator. What is the market? What is the market kind of telling you? And so usually when you have a downdraft or an updraft, you kind of get so far away from that 5-day moving average, and you kind of revert back to it as a test, right? So today's move was all about, for me, reverting back to that 5-day moving average and really testing it. Right now the 5-day moving average is about 2036. So that still is about 10 points. And that's right around where the 50-day moving average is, around 2040. What I'm expecting is tomorrow is that we see some strength on the open, right up into those averages, and then you got to watch and see what happens throughout the day. If they smack them back down and turn them over, it'll probably be not so nice. If they are able to hold them up in that area, then and they get some more volume, and we get like an accumulation day, then the Bulls may be back in control. But as of right now, the market's definitely under pressure. The sellers are definitely in control. I think they can turn it on like a light switch at this moment, right? So we'll see what happens, the Thursday and Friday. But yeah, I think that to me, the S&P 500, like you had the S&P 500 up, it set a new high, right, towards the end of the year. But the true strength in the market has been in the QQQ, has been the Nasdaq 100, and the fact that it didn't set the new high. And then you go look at the Nasdaq, which barely, I mean, by like 10 points, barely set a new intraday high. Kind of has me, well, it doesn't kind of have me, it has me in all cash right now, virtually. Not 100%, but over 90% in cash. That's where I'm in. I'm really just waiting. To me, I don't like to play hero so much. I tell you that all the time. I don't like to play hero and be the guy that catches the bid in the market and turns it around. I like to kind of let the market say, okay, we've confirmed we're going up, and then just kind of follow it up. So I'll be watching tomorrow.
Yeah, I mean, it definitely seemed though today. I know we're talking a lot about today, even though both of us like to think a little bit longer term than
Right.
intraday trading. Um, it seemed like today, after the econ data came and surprised, futures and the market itself really started to take off. It seemed like that got the bears scared.
Yeah, no, because I mean, I think that the whole bear argument has been the Fed's only there because things aren't as good as we believe them to be. So definitely, and I was in the camp that the economy wasn't as strong. I didn't think that it was as strong as it was, and 2014 was really a show me and prove me year, and it proved to me that it was as strong as some people like you and other market participants have been saying that it is. And so I'm really in the camp that you're seeing that you're getting that. It may not be organic growth yet, like we had in the 90s, where it's just, I mean, pure organic growth. Some of this may have been Fed induced, but we're certainly starting. It's catching its feet. You know what I mean? It's finding its way, and so I think the economy is improving. And hey, again, look, we could sell off 7, 10%. We're down what now? 4% now, 4.5%.
Yeah.
We could sell off another 10%, and it's okay. It's really okay. We could go all the way down to the 200-day moving average, and it's really healthy actually, for all that price discovery to happen, and then you'll have new buyers come back in. It's actually a good thing, But the only time it's a bad thing is if you're getting long today, and adding to positions, and the market turns back. Someone like you've been long for a long time, so I'm sure that you weren't adding today. I mean, I don't know what you were doing today, but
I added to Apple was on Monday just at like 105, and I mean, I just because I thought it was acting a little overdone, because it wasn't like the market in itself where it kind of took back off. It's been going down about 5% or so. So I thought, might as well just, and it wasn't like I doubled my position or anything like that. I added just a little bit.
right,
That's
yeah, right. I mean, you weren't. I mean, I'll tell you this: when we rallied, what was it? December 19th, I think. I went. When we had that huge day. I think it was the day after the Fed. Actually, it was the day of the Fed meeting, of the press conference. Um, when I saw how strong the market was and we closed above the 5-day moving average, I was fully invested on that day. I went all in, and it turned out to be a good trade. I didn't see that. What I'm saying is that wasn't today for me, right? I didn't see today's action. Today's action was constructive, but I didn't see today's action go, I need to buy today, right?
Yeah.
That being said, some stocks that I follow, Ambarella, there were some stocks that were breaking out and doing some good stuff. But I like to be more cautious when the market has been acting the way it has. That being said, I mean, talking about forecasts and this and that, and people have S&P forecasts and this and that, we could sell off another 15% from here, all through January, all through February, and spend the next 9 months doing nothing but rallying back, right?
Yeah.
So that's the perspective I like to take on it.
Yeah, I'm actually going to re-show that chart of the S&P just because, I want to go and show people, when we got our gains, you got to remember, this was January, this was February, March, April, all the way through May. We were pretty much on a flat line for what seemed like forever.
Yeah.
And then it kind of picked up in the summer, and it wasn't until really October, once we got that nearly 10% correction, that we started to really start taking off. I mean, we were on this kind of 190 line in the S&P
Yeah.
for what seemed to be forever.
Yep.
Just because someone forecasts an 8% up year doesn't mean stocks are going to go 8% in a straight line. It could mean we go down 50% and we get 58% upside.
And exactly, there you go. I mean, that's it right there. I mean, that's the thing that I like. If there's anything that I want to teach people, or people take away, is that when stocks sell off, it's not such a bad thing. People on shows oh, today was a tough day on Wall Street. Well, if you were short, today wasn't a tough day on Wall Street, right? If it was a down day, you know what I mean? So, it's all your perspective, and so, like, if you got long in that October sell-off when Ebola and this and that. By the way, where is Ebola? Um, in
Yeah.
the head. And by the way, my prayers and thoughts go out to France and the people out there in Paris. As you know, I'm sure you heard the attack today. Yeah, so my thoughts and prayers with them. But that being said, if you got long off that October bottom and you just held to the end of the year, even though we sold off in the year, you had a great year. People that were trying to trade around the market in the early part of this year didn't do so well. People that were long biotech, in the beginning of this, that March sell-off you had, didn't do so well. That being said, towards the end of the year, if you got long biotech at the end of that March sell-off, you had a freaking awesome year. So it's really timing is everything, and that's why you have to kind of you don't fight the market. And right now, I don't think anyone would really argue with the fact that the market is under pressure at the very least, and it needs to prove to me at least that it is no longer under pressure, and then we'll be all right.
Yeah, one of the big things that I like to go and talk about, because my perspective on the market, and this is why I love Josh Brown so much, is because he shares the same view. If you trade every day and you're an at-home trader, that's fine, but, some of the people that are at home, shouldn't be like that. You should never be trying to trade constantly unless you're an options trader or something like that, you don't have to trade all the time. You can go and build a portfolio of diversified stocks and do just fine. And go and I'm longer term, and when I added on October, it was at some unbelievable prices, like Disney at 77 when it's at 94 right now, or Blackstone at here, let me just, I have it up on my desktop, at 27 when it's at 33 right now. There are some great times that be had. But at the same time, I do have to go and say I do have a holding in my portfolio that is a hedge, the hedge ETF that actively shorts the market. So on down days, I'm not sweating them as much, but at the same time, I'm not getting as much upside return.
Right, and that is something that people should consider. Is having that balance between being tactical, taking advantage of short-term price moves, whether that's to the upside or the downside, and then also hedging themselves. Yeah, you do give up some upside, you give, here or there, but to trade every day, you're at the whim of the market. If the market decides that day that it's going to be low volume, then that really sucks for you if you trade every day, because you won't be making that much money because there just won't be enough people playing with you. And to even follow that up with one more comment, you'd have you're going to assume that you're going to be right every time, and so it's very difficult, and there's no proven strategy to day trading the market, right? You can do it, and you can leverage your money a lot, but the fact is that in order to you want to be consistent. You want to be consistent. The best way to be consistent is to have a longer, medium to longer term view. And the shortest time frame I really look at markets or make a market decision is daily, right? That's the smallest time frame I look at. I do view hourly charts, but I only view them in the context of my daily perspective, right? So I don't go, oh, whoa, look what's happening, and change my view based on an hourly chart. Never do it. I only look at weekly and daily. I like looking at the hourly just because you can kind of get a sense of what the market is doing that exact moment. But I don't change my view based upon it did this or did that. I just don't think it's a consistent way to make money in the market.
Yeah, I think if you do try and do some daily stuff, I think you should, at least in maybe another account, whether it be with an advisor or something, that you should have some longer term stocks, whether they be just a simple index fund, or what have you. I mean, when I'm on my desk on like, when I'm not at school, I may, I switch to a 5-day chart. I mean, a 1-day, 5-minute chart just because I like watching, what they do on a timely basis. But I mean, right now I'm looking at strictly yearly 1 days just because, that's how you get a real perspective of what a stock is doing. Now, if you don't care about what a stock is doing long term, I mean, I've day traded Herbalife on the day when Ackman did his presentation and shot up 22%. If you don't care about the stock unless it's on super big volume and it's really liquid and stuff like that, then look at a 1-minute chart. But if you actually care about the company and want to see what it's actually doing, you got to go longer term.
Yeah, there's no doubt that the longer term view is going to give you a more accurate picture of where things are going to go. Because and also just looking at price action. A lot of people like using, I like this indicator or that indicator. I do use indicators every once in a while. Like if I look at a chart on stock charts, they already have the MACD or the RSI. So I usually throw away the MACD, but the RSI. But I would generally tell people to ignore market indicators, because at the end of the day, a market indicator can do one thing and then boom and snap the other way in the next second, and you'll go crazy, buying and selling because this magic indicator is telling you to do it, as opposed to saying, hey, this stock is acting well around this 50-day moving average, or it's above its, or whatever your kind of thesis may be at the time. But there's no doubt that looking at the daily movements, and for guys like us that want to be in the business for a long time, if we want to have families, or you want to have any kind of colored hair by the time you're 40, watching the daily movements and day trading, it's not sustainable. It's just not, and so that's part of the reason why I don't do it.
I mean, I use different market indicators. I have moving averages on there. I have volume, and I have historic versus implied volatility. But if you look at that stuff, it's if you're going to use indicators, use a broad view of indicators, because that way you're not just sucked into the 5-day moving average with not even looking at volume, because a moving average it's just strictly price, and it doesn't tell you a whole lot unless you look at volume.
Well, I don't consider really moving averages indicators. I mean more like people like using DMI or MACD or a lot of the implied volatility. I don't really consider that an indicator. That's the volatility going on in the market, right? So I think of indicators as anything other than the natural movement or the natural ticking of stocks. Like you said, moving averages are just price, right? So essentially, you're just looking at price, and that's not an indicator in my book, at least.
Yeah. I think I put this on so that it's an hour, so we should probably start talking about the markets as opposed to telling people what they should and shouldn't do.
Right.
even though that is some good advice, because I mean we've been doing this for a while, and some people out there who first start off, whether it be just using some discretionary money to trade, may watch this and go, oh my God, I was trying to play stocks on a 1-week basis, and I'm not making any money, and he watches this and he goes, this is eureka. But I know we talked on Sunday about one of your trends being cybersecurity. So talk about that.
Yeah, definitely. One of the sectors or industry groups that I really like is the cybersecurity. Just recently in the headlines, the Sony hack. But in 2014 and 13, you had Target, you had J.P. Morgan, you had Wells Fargo, you had all these different companies, and the thing is that these companies aren't protected. That's why they're getting hacked. And so trends in 2014 that I see are like the Palo Alto networks, the Vasco Data Security, the Qualysys networks of the world that defend these large corporations from cyber attacks and actively defend them. Most of these companies are targeted, and infiltrated because they're not protected and it's very easy to do. So that's definitely a trend that I see in 2014 that I think it did well in 2014. I think it'll continue doing well in 2015. That the entire sector really, which it's only about 22 stocks in the entire universe, and of those only there's about 3 or 4 that catch my eye. But for people that are looking for an area to put money to work, I'd definitely say cybersecurity. Another one I'd say is the airlines. I think the airlines do have some more room. You know, oil's lower. If you continue getting this improving economy, which I think we will get, people will travel. You know, airfare is you know relatively cheap to where it's been, and I think more people find it accessible, and more and more people are traveling, which is a good thing for the airlines.
Yeah, I mean, you know, you can't. Recently, I was on a trip to Michigan, and my dad and I drove there, and it took us 9 hours to get there versus my mom and my sister leaving the same day, flying back to Huntsville, which is not an easy airport to get to, and they got back, you know, at 1 o'clock, and we both, you know, left the house at 9, you know, Eastern time. So I mean, it's, you know, and we didn't get there till 8 o'clock at night. So it's like, you know, it's a lot easier, and you know, more people are going to do it. You know, and the more global, you know, the world becomes, the more airlines could be more prevalent. And I do like that trade. I do like that that idea. I mean, airlines have run up a bit, but you know, I think on any type of pullback, if you bought it on the Ebola scare, you know, I tip my hat to you because that was an incredible trade.
Oh yeah, I mean if you were buying airlines on the Ebola trade, wow. I mean, boy oh boy did you make money. Um, and you know that just goes to show you like how irrational the market can act sometimes. People aren't going to travel because of Ebola. I'd be, you know, if you're when you're in the moment and the market's down 8%, I'm sure that makes sense, you know, and it makes sense to everybody. But when you know think about it and go, okay, in 12 months, in 6 months, are people not going to be traveling because Ebola? You know, probably not. You know, so I mean, like, look right there, United Continental, $40. You could have picked it up at it's almost, you know, close to 70. That's incredible.
Yeah, I mean, the thing about the Ebola was it was almost the opposite of irrational exuberance, where people were just, when you heard the news and it was like the apocalypse was coming, you know, are people going to start going, you know, start not going to a Starbucks to get their daily coffee because they're scared of Ebola? It's like, people, come on. And
Right. I mean, it just makes no sense, you know, and that actually speaks to today's, you know, the recent kind of market. Why, you know, the only reason I'm slightly concerned, other than you know some of the reasons we've already mentioned on the show, but you know, to add to that is why is the market going down? I mean, there's absolutely no reason, based upon the data, based upon everything that the Fed has said, there's no reason for the market to be going down. It should be going up. So when it is going down, that is what's concerning. It's not when it's going down for an irrational reason like Ebola, right? At least there's some reason you can go, okay, that's ridiculous, you know. But you know, maybe certain sectors, okay, banks, I could understand why they're going down because rates are going lower. You know, oil, energy, I can understand why that's going lower. Discretionary, not sure why that's going lower. You know, let's see, what other sectors are there?
you know,
The
I mean,
state,
yeah, Staples, XLP, right?
why, right? XLP. Why are staple stocks going down? I mean, the 10 years hitting lower and lower. These things pay dividends, and you know they had a nice day today. But why were they trading down the last 7 days? I have no idea. You know, that being said, that chart right there that you got up looks pretty constructive actually. Looks very good.
I mean, a trade I've been in, XLU, I can understand why it sold off a little bit, you know, at the, you know, in late December, just because, you know, this stock up until right here, where people really actually found out that it was being, you know, a huge winner, you know,
Right.
this stock was up 30%. So I can understand why that would sell off quite a bit, because, you know, it had been one of the winners along with healthcare, but, you know, And then you think about it again, and it's like, okay, well, where do you go for protection in, scary times? You go to utilities, you go to staples,
Well, I mean, this goes back to what we were talking about in the beginning. Where have people been going for protection? They've been going to TLT. Guy Adami of CNBC has been dead on with that trade. He's been pounding the table on TLT, and he's been dead right. It's just gone nothing but up, and it pays you a yield.
Oh yeah, and it pays you something like 3. I know XLU pays you 3%. I think TLT does too.
I think it's a little bit smaller. I could look it up, but I think it's smaller than that.
But I mean, yeah, I mean the yield plays have definitely been. I mean, you just look at the MLP space, and it's been almost ridiculous, the search for yield.
Right, and yeah, actually the TLT it's a 2.5.
2.5. Okay.
So that's bigger than the 10-year as well.
And what's actually interesting is now that I'm watching this chart is we haven't really had a huge volume day in TLT since those October what for the S&P was October lows, which for TLT would be October highs. We haven't seen a huge volume day except for yesterday.
Right, right. Yeah, yesterday was definitely a huge volume day for TLT. And people just continue to pile. And the truth of the matter is that I don't see that changing anytime soon. I mean, TLT's on the verge of knocking. Actually, did it just close? Yeah, it closed at another all-time high today or yesterday. Closed at an all-time high yesterday. It closed 20 bips off of that today. But if you look at the TLT and the day that it had today, it closed on the higher half of the range for the day, and it looks as if it wants to keep going higher.
I do kind of question. Now I don't have Bloomberg Pro or anything like that, so I can't go and see what it's compared to with the actual bond yield or the bond price. But I wonder if to a degree some of it has been it's not trading actually in tandem with bonds just because it is a financial instrument. So
Right.
so you do go and you see a little bit of exuberance perhaps in bond yields, in the TLT.
Yeah, um, that's possible. But again, I think it speaks to just the general. The action in TLT really has me thinking that it really has me thinking that stocks are going to go lower, because if stocks were going to go higher, people would be getting out of bonds. Why would you? If we're in a growth environment, which again, I'm in the camp that we are. I think that we're on the verge of entering a awesome growth period. If that were true, though, it should show in the sense of higher equity prices, lower bond prices, but that just hasn't been the case. So I'm not one to fight what's in front of me, and I think bonds are definitely telling you something.
I think they are too. I think maybe you have a little bit of a bond, too big of a bond buy, just because. On one hand, I do see that probably demand for U.S. bonds is probably there because you do have the Germans, and the Japanese over there going, hey, for 10 years, I can get a 0.5% or 0.3% gain on my money versus U.S. 10-year bonds, same duration. I can get 2%. That seems, I mean, for the Germans, that seems like a no-brainer for them.
Yeah. For their government. I mean, but see again, the trade in Germany though, and this is again what I was talking about earlier, is that the trade in Germany. Remember, Germany had a negative equity year. Pull up the EWG real quick, and you have it on a 1-year chart, or
Yeah, I
what is
have
it
it
on?
on a 1-year chart. I can go up further.
Well, 1 year's all right, but I mean, they had a negative equity year. So no wonder their bonds are just being bought up. Because it's a flight to quality, right? People are like, forget this. I'm not going to be in the equity market. I'm going to go in the bond market. And if you look at that, I mean, it looks like it's going to roll over even harder, which again makes me think that the equity market's going to go lower. I mean, look at that. What moving average is that? The yellow one?
The yellow one is the 21-day.
Okay, 21-day. Right. So you're about to have the 21-day go below the 50 again, and you can see what that did to it last time in July. It sent it from 31 to 26, and then we rally back to that 200-day when we have a death cross as well now, and it looks like it's rolling over again. You know, it just, I mean, Europe is just crap. I mean, I'll say that. I mean, Europe is crap. So, I mean, the case for our equity market is that you're getting a 1 point something dividend yield, and you have the growth, and we're more solid than anyone else. Definitely more solid than crappy Japan, crappier Japan than Europe. So I mean, to me, it's amazing to me who is buying Japan, who's buying Europe. I mean, I'm in the camp of buy US all day, but who's buying these other countries? Look at Japan. I hadn't even looked at Japan this year, but wow. I mean, what a collapse is happening over there.
Yeah, and you wonder because all these new markets are all because well, I mean, just look at the volume difference between February, January, and going into October, December, and all this stuff. Just look at the volume difference.
Yeah, I mean that's just and look at and here's the funny thing about Japan, right? It's like their volume chart looks the exact opposite of what the U.S. volume chart looks like, and yet they've been flat for a year.
Yeah.
So that tells to me that tells me something. That tells me that people's risk appetite is low in general, and that our equity market's probably going to continue higher, and Japan's probably going to roll over. I mean, I'm looking at global bond yields right now. We're at 1.97. Okay.
Here, I'll stop sharing my screen so you can share yours.
Let's see if I can do that here. Screen share. Entire screen. All right, can you? There we go. So yeah, I'm looking at the on Bloomberg here the global bond yields. You have ours at 1.97, but look at this. Greece has a 10% bond yield. Okay, but look at the rest. What's concerning to me is look at the rest of Europe. Why would one country in Europe have a yield that is 5 to 7 or 8 times every other country out there? I mean, it just makes no sense. It makes absolutely no sense, and you can see the order of strength. Switzerland is the strongest. Germany is the next strongest. France, or excuse me, Netherlands, then France. I mean, the rest of them, you don't even waste your time, other than Britain. But and then look at Japan, 0.29.
Yeah, it's definitely between Europe and Asia. It's definitely this flight to quality, flight to perceived safety. That is
right, and that right there is my big what I'm interested to see for 2014. Is it a flight to perceived safety, or is it the flight to real safety? Are these governments going to be able to continue to spend? I mean, forget about our government. Just Japan is, oh my gosh, they've been in a global or a secular decline for 30 years. I don't care what their equity market's done. Their economy isn't growing. So how or not how, but why people keep dishing out money to them or loaning out money to them to spend is just absolutely incredible to me.
It's a great question, and the greater question probably is when will the bond bear market begin?
Yeah,
Because
I mean that's
it's
something
coming.
to watch.
It's definitely coming. I mean, I don't want to say I don't want to be a Peter Schiff or anything like that, but I mean, But when you have countries that start to go and get very, very long duration bonds start to go negative, that's bubble territory. I'm sorry.
Oh yeah, I mean, there's no question. I think that that bonds around the globe are starting to enter bubble. I mean, when you're getting below 1%, I mean, look at, because here's the thing, Germany, as bad as Germany looks, and I'm going to pull up Germany right now, um, as bad as they look, okay, and this is a monthly chart, right, and you can see their relative strength ratings, the S&P is horrible, 29, horrible, okay. If they continue going lower, what is that going to do to their bond market? Lower, so eventually what are you going to hit, a 0% yield? I mean, I don't, is that even allowed? I don't know. I mean,
the German 5 years are already negative yields. So to me it's just a matter of when is Japan going to turn negative, and if that happens, what's going to happen. I don't know, but it's an awfully good question for a lot of people to ask.
right, and I look at it like, look, this is right here, this was in November this month, or December rather, when we had that huge, Japan announced that it's going to, be buying more global equities and this and that, and we're still below, in the EWG and the DXJ, we're still below the 2007 peak, still.
Oh yeah, I mean it's a little it's a little it's a little scary to me. It really is. I'm not gonna lie.
Right, and so, and to follow up on that, what I think, what I see for the S&P 500 is, here is this lost decade, we called it, right, from about 2000 to 2010, okay, where we went sideways. If we have some kind of crazy stuff going on in Europe, I don't see why we wouldn't retest this 1580 level in the S&P 500. Why wouldn't we, right? You look at, I'm talking about the computer software security. Here's the 2000 high. It breaks out from that in early 2013 and came back and retested, right, and then took off again, and it may retest it again and then take off. Same thing down the line. You look at airlines. Look, in that October low.
We can't see your screen. Oh, no, never mind. Now we can.
Oh, okay. Oh, it had to catch up real quick.
Yeah.
Yeah. So here's airlines, right? So to say that, and Josh Brown actually had, I like him as well. He had a great piece, and I'll pull it up right now. It was chart of the day. Don't be shocked was the name of the chart, and he basically, I'm not going to read the whole article, but he basically suggests, or the person that wrote the article basically suggests, that if you look at the breakout from the 2007 high, and you look at the S&P from 66 to 82, in the 80s we had that decline that retested the peak. Why wouldn't that happen here, right? And if you line it up with the way that these investment banks work, right? If we saw a sell-off, like let me ask you a question. I'm gonna take it off screen sharing here. So I want to ask you a question. If we sold off, right, from where we're at now, back down to 1880, what do you think when we close at 1880 everyone's going to say?
Oh my God, it's the next bear market, all this type of stuff, and
yep. It's all over. It's never going back, and that right there is when we will have a hangout and tell everyone, you better get in now, because if you don't, you're going to miss, unless there's something else, But at the end of the day, even if, let's say we wake up tomorrow and the U.S. defaults on its debt, okay, and it says we can't pay our debt, we default, you're going to have, obviously, risk appetite go down. You're going to have volatility spike, but at the end of the day, are we going to go through the next 10 years are going to be able to restructure their debt? No. It's going to be maybe 3 months or 6 months, and whatever the case is. But the fact is that over time, the U.S. is where you want to have your money. I think in 2015 it's where you want to have your money. Not necessarily today, but I would say be on the lookout for that that test for that sell-off, and then look to get in. You know, and it's not going to be easy because everyone's going to tell you it's never going to be the same. It's all over, and Peter Schiff's going to come out, and it'll be his day, and it'll be Centelli's day, or a couple months. You know, they'll get to do their parades, and that'll be really fun to watch. You know, but at the end of the day, you know, it's not always as bad as they make it seem. And you know, when you put it in perspective, a 20% sell-off is what, a fifth of the market's value. That's nothing. You know, that's nothing. So you know, it's really has to do with timing. And you know, what I would say is, if you're going to take away anything, I'd say today is not the time to necessarily be back in the market. I think you have to watch it, you have to see, and see what happens, because we could get that sell-off and that retest. And we've mentioned the events that could cause it, because this global global glut for yield, and this global glut for bonds and debt is out of control, to say the least.
Yeah, and to add to your point about not getting into the market, I'd say the market as a whole, maybe not. I mean, if you see names that have been really, really beat up, I'd say take a shot for them. I mean, like I did with Apple, I took a minor shot just because it's been down worse than the market, you know. So why not take a shot at it?
Yeah, no, I mean, there's definitely spots to pick. I just mean, now is what I'm saying is now at this exact moment, and again, it could turn around tomorrow, right? But as of today, I can only go off what I have today. As of today, I wouldn't say, and I wouldn't feel comfortable telling anyone, yes, be 100% invested today, right? You know, because there are all these things out there that are, you know, that are lining up and kind of telling you that, you know, there may be something on the horizon. Now, you know, one thing I want to keep in mind is, I'd say you want to have a positive view, but in 2007, guess what everyone was saying? It's so great, you know, you got this, you got that, you got that. It's so, you know, people are always going to say it's all great, and that's what ends up hurting people, you know. And I think that if there's anything that's going to hurt people in 2014, or 15, excuse me, not long term, but over a period of months, would be the buy the dip mentality, right? Everyone has been conditioned over the last 3 years, buy the dip, buy the dip. Our good friend and founding member of Leaders Investment Club, Julian Marchese, even wrote an article in 2013 saying buy the effing dip, right?
Yeah.
So everyone has been conditioned. Now, when, I'm not saying this is it, but when the buy the dip no longer works, it's not going to be like a slow trickle. Oh, it doesn't work anymore. Let's go ahead and start selling. No, it's going to be, holy moly, this is not working, and people are just going to hit the ask button. And you're going to have a lot of people that were trapped up at 2000. You're going to have people trapped at 1950, and it'll just get worse and worse and worse. And then, you know, if you're positioned correctly and you're not 100% invested, then you can take advantage of it, right? But if you're 100% invested, you're going to take all that pain, and then you'll sell on the last day. I guarantee you that, because that's just how it works, you know.
Well, it's a good point, and you know, if you want to avoid some of that, you may want to bite your teeth and add some type of hedging to your portfolio, a bear market ETF, or just be more diversified. The high multiple stocks can never go up forever. We always see this during minor sell-offs like now. Anything with a super high multiple gets slammed, and it's the first one out the door.
Yeah, and the reason for that is because there's something called, a guy on CNBC suggested, I can't remember, it's the something effect, where when people have gains, they're more inclined to sell their winners faster than they are to sell their losers, right? And it was a study done, I'm sure they studied people and set them up with portfolios and stuff, and that makes sense, right? You're going to be more willing to say, hey, let me take this profit, then let me take this loss and hold on to my profit. So that's why a lot of times you see the beta names get demolished, because people have profits in them. Managers and funds have profits in them that they want to capture, and so they do that, right? you have to be tactical and objective, right? You can't just have one mindset and it's only going to be this way and it's only going to do this, because that's when you get in trouble. And to say that it's only going to be up, people have these forecasts. Yeah, that's not how it works. You don't open up the year and on January 1st you go from wherever we closed to the target.
Yeah.
There's a lot of days in between that.
Yeah, just wrapping it up here. I mean, I think the major takeaways from what we've been discussing is, watch out because you never know what's coming, and make sure you have a wide range of views. Be diversified, both in your portfolio and in your head. Because you never know who's going to be right, so you might as well pay attention to everything.
Yeah, no, definitely.
Well, Nolan, we always have interesting discussions, and I just want to, thank you for being up on here, and I also want to give a shout out, to all the members of our Leaders Investment Club. Make sure everyone out there go, follow them and give them some love because they got great ideas as well.
For sure. And thank you for having me on your show, man. I appreciate it. I always have fun chopping it up with you. Hopefully we can get this going like once a month or something, man, because I think we get a lot of good ideas out there and help other people and help ourselves at the same time. So it's a good thing.
All right, so I think we're going to leave it up there. Thank you, Nolan.
All right, man. Thank you. Take care.
Take care.